One decision can raise your rent overnight. One decision made in a closed room can raise your rent, your loan payments, and even your grocery bill. And most people don't even know who made it. You just feel the pain. You feel your monthly payment go up. You feel the price of food climb. You feel it getting harder to breathe financially. And you start thinking, what am I doing wrong? But here's the truth. Sometimes you're not doing anything wrong. Sometimes the system shifts, and you pay for it. So today, I'm going to explain who really controls interest rates, how that decision spreads into your everyday life, and what smart people do to stay ahead. Stay until the end. Because once you understand this, you'll stop being surprised by the economy, and you'll start planning like a person who actually knows the rules. Let's start simple. Interest rates are basically the price of borrowing money. When rates are low, borrowing is cheaper. People can buy homes easier. Businesses can expand. Credit cards feel less painful. And everything seems like it's moving fast. But when rates go up, borrowing gets expensive, loans get harder, payments rise, and spending slows down. That's why rates control the economy like a thermostat. The problem is, most people don't know who's holding the thermostat. In the United States, the main group that controls interest rates is the Federal Reserve, also called the Fed. And no, it's not a normal bank you walk into. It's the central bank of the country. The Fed has a job: keep prices stable and keep the economy from overheating or crashing. But here's the part that matters for you. When the Fed changes rates, it changes the cost of money across the entire system. And even if you've never heard a Fed speech in your life, you've felt the results in your wallet. Now, you might be thinking, okay, does the Fed just wake up and pick a number? Not exactly. Decisions are made through meetings, usually by a group called the FOMC, the Federal Open Market Committee. That sounds complicated, but here's the simple version. A small group meets, studies the economy, and decides whether to raise rates, cut rates, or keep them the same. And whatever they decide, banks and markets react immediately, sometimes in minutes, and that's why one decision can change your life fast, without you getting a warning. Now, let's explain what the Fed really controls. The Fed doesn't directly set your mortgage rate or your credit card APR. It controls a short-term rate that influences what banks charge each other. But that short-term rate spreads like electricity. Banks raise their rates, loan rates rise. Credit becomes tighter, and the entire cost of living starts shifting. So even though the Fed's rate sounds like it's far away from your daily life, it ends up touching everything. Here's how it hits you first. Loans. If you have a variable rate loan, a credit card balance, or a new car loan, rate increases can raise your payments. Even if you don't change anything, you pay more. That's why some people feel broke randomly. It's not random. It's the cost of money increasing behind the scenes. Now let's talk about rent, because this is the part that shocks people. You might think, I don't have a mortgage, so higher rates don't matter. But here's the twist. Higher interest rates can push rent up to when rates rise. Buying a house becomes harder. More people stay renters. Demand for rentals rises. And landlords also face higher costs if they have loans on their property, so they raise rent to cover it. That SY rate decisions can reach you even if you VA never borrowed $1 in your life. And yes, it's unfair, but it's real. Pattern interrupts, the Fed raises rates, and suddenly your landlord starts acting like they got a promotion. Now let's connect rates to groceries, because people don't expect that. Interest rates affect businesses too. Companies borrow money to grow, to buy inventory, to expand stores, and even to survive slow months. When rates rise, borrowing costs rise. Businesses pass those costs to customers. That means higher prices. It's not the only reason groceries go up, but it's part of the pressure. Money gets expensive, and everything built on borrowed money gets more expensive too. Now, here's the cliffhanger. If higher rates make life harder, why would anyone raise them? The answer is inflation. When prices rise too fast, the Fed raises rates to slow spending. It's like putting brakes on the economy. Higher rates make people borrow less, spend less, and cool things down. So, in theory, raising rates can slow inflation, but in real life, it can also slow jobs, slow business, and create pain for families. That's why these decisions are powerful. It's not just economics, it's real life. Now, here's something most people don't realize. Markets move based on expectations, not just decisions. Sometimes the Fed doesn't even have to raise rates to cause damage. If people believe rates will rise soon, lenders start adjusting early. Mortgage rates can jump before the Fed officially changes anything. Your loan offers can change. Your credit costs can change. So even talking about rates can move the world. That's how sensitive the system is. Now, let's talk about who benefits when rates change. When rates are low, borrowers benefit. People can get cheap loans. Big investors can borrow cheaply to buy assets. Companies can expand faster, and asset prices often rise. But when rates rise, savers benefit more, because savings accounts and bonds can pay higher returns. Also, people with cash get power, because they can buy discounted assets while others struggle. So every rate cycle creates winners and losers. It's not equal. Pattern interrupt. The same rate that hurts your car payment can help somebody else earn more interest on their money. That's why the game feels rigged. Now let's zoom out, because there's another layer. The Fed doesn't work in a bubble. It reacts to inflation, jobs data, consumer spending, and global events. Wars, oil prices, supply chain issues, and market crashes can all change what the Fed does. That's why rates can feel unpredictable. But there's a pattern. When inflation is high, rates go up. When the economy is weak, rates usually go down. It's like trying to balance a heavy weight on a small stick. One wrong move and it falls. Now, the biggest question: What can you do about it? You can't control the Fed. You can't vote rates up or down, but you can control your personal strategy. First, try to avoid high-interest debt, because rate hikes hit hardest there. Second, build an emergency fund, because high-rate periods can bring layoffs and slower business. Third, keep improving your skills, because income protects you more than opinions do. Fourth, if you borrow, understand fixed versus variable rates, because fixed gives stability, and variable can surprise you. And fifth, don't panic when rates change, because panic creates expensive mistakes. Here's the real lesson. Interest rates are not just a news headline. They are a lever that moves your entire financial life. And that lever is pulled by a small group of people making decisions based on a massive system. You don't have to love it, but you do have to understand it. Because once you understand it, you stop being shocked by higher rent, higher payments, and higher prices. You start preparing early. You start moving smart, and you start building wealth with strategy, not hope. If you want more money, truth, financial history, and wealth lessons in simple language, subscribe to Cashfree World and hit like so this reaches more people who need it, and comment below. Do you think interest rate decisions help the economy or hurt everyday people the most?